Well, welcome everyone to FutureSight's webinar, Investing in AI, Opportunities and Perils. Are we in an AI bubble? We're delighted to host you over the next hour as we explore this interesting topic. We have a lot to get through, so let's get started. My name is Krista Lariviere, partner here at FutureSight, and I'm joined by team member and venture builder, Cindy Gamble. Cindy, give a wave. Cindy's also making sure everything runs smoothly with the webinar today. And of course, our keynote speaker, John Carbrey, who will be introduced more formally in a few minutes. So just a couple of housekeeping items. We are recording this webinar, so you will receive the link to it in our follow-up, so no need to take notes. And please ask questions in the chat throughout the presentation. We will have a Q&A at the end. And if we don't get to your question in the Q&A, we will make sure to answer your question via email and get you the answer. So let's jump in. I know we're here to talk about AI and investing, but first, just a little bit about FutureSight. So FutureSight is a venture studio, and we have offices in San Francisco and Toronto. And simply put, we are in the business of building companies from 0 to 1. A venture studio is an institutional co-founder that proactively invests in and builds ventures by using expertise of a central services organization that uses a playbook for repeatable venture building. And so how is a venture studio different? We invest the highest amount into human capital at the earliest stage compared to other entities in the ecosystem, such as accelerators and incubators. We partner with repeat founders to build alongside with from day zero. So when you look at all the stages of company building, from ideation, validation, creation, growth, scale up, and large enterprise, we invest and build with the founders from the beginning through to the growth stage, ensuring early ventures are de-risked and ready to scale. Our niche: we co-found and fund vertical B2B AI SaaS companies with values-driven leaders. And our studio leadership team. So we're a dedicated team of founders, operators, analysts, and builders, passionate about entrepreneurial success every single day. Across the team, we've been building technology companies for decades and know what it takes to win from 0 to 1 and beyond. And in this era of AI, we excel at finding the real AI opportunities that will survive the bubble. And some of our portfolio companies. So Caring AI is a health tech company detecting early stage dementia with voice AI screening. Addy, an edtech, voice first AI global school counselor. Mercata is fintech with an AI native operating system for fundamental investors. Crewscope is construction tech, an AI field operation platform for construction and industrial teams. And Medivox, health tech with a patient-first AI medical documentation system. Awesome. And now, John, introducing John. Without further ado, it is my pleasure to introduce John Carbrey, FutureSight's founder and managing partner. John is a serial entrepreneur, having founded and exited 4 companies as CEO and CTO, with experience scaling and building from 0 to 100 million in annual recurring revenue. He is the recipient of many entrepreneurial awards, including the Ernst & Young Entrepreneur of the Year Award. John founded FutureSight to answer the questions: how can we help entrepreneurs more successfully get through the first 50 steps of building a business? And how can we turn company building into a science? So John, over to you. Take it away.
Awesome. Thank you. Delighted to be here with all of you. Thank you for the introduction, Krista. So we're exploring this question, investing in AI, opportunities and perils. I wanted to just let you know I'm going to highlight 5 places where you can lose money and one place where you can make money today. I think the question that a lot of people are asking is, are we in an AI bubble? And I don't know if you're listening to the news, it got to a fever pitch yesterday, I think, on this question with NVIDIA's earnings. Everyone's wondering, okay, is the bubble going to pop? And they did quite well. So we're going to explore this question a little more and how to put it in context, and hopefully it can be instructive not only when you think about investing, but also investing your time as well. So to start, let's just frame that there are different kinds of bubbles. There are financial bubbles, there are industrial bubbles. When I think of financial bubbles, I think of meme stocks, I think of initial coin offerings, which are mostly kind of, in both cases, driven by capital flows and not underlying value. I think of the great financial crisis. These are financial bubbles. But there's also another kind of bubble, which is an industrial bubble, where we build value and redefine industries. And often these industrial bubbles sit on top of technology innovation. And so if we kind of go back through history, this is something we're familiar with. We think of compute. The measure of this bubble, or the kind of rollout of compute over time, is like computations per second. And you can see this is a 120-year graph of the evolution of this, all on log scale. Obviously with the internet connectivity, and this is covering 40 years of kind of internet bandwidth usage. So an industrial revolution here. We'll talk a little bit later about the telecom bubble, because I think there is a moment in this phase in the 1990s where there were things that were bubble-like, and let's explore that question. And now in the AI revolution, I think the question is, what is the measure of the AI revolution? And for us, that measure is AI tokens. I think fundamentally that's the measure of the evolution of this revolution. Now, the measures of AI tokens are in the like billions and trillions, just because a single conversation can have thousands or tens of thousands of tokens used. But fundamentally, this is kind of the world where we're using AI tokens, which are kind of like the most basic form of reasoning. And so when we kind of look at AI tokens for this AI revolution, perhaps AI bubble, you start to see kind of massive growth rates. And so here's some of the some stats on OpenRouter. 3,800% growth rate year over year. And we have some new data from Google on their use of tokens. 50 times increase in token processing year over year, and that's only continuing in the last, say, 2 quarters. They've kind of doubled, more than doubled again. So we see this kind of massive increase in the use of AI tokens. And so here we are, we're in this industrial revolution tied to AI, or perhaps it's a bubble, let's see. But fundamentally, these are now being handed out, these awards. You don't get a YouTube views award anymore, you get the 100 billion or the trillion tokens used awards from OpenAI. And so let's explore this more. Let's dig into kind of this AI build out. And I want to just use this framing for technology revolutions. This is Carlota Perez, and Carlota explores the dynamics of bubbles and industrial revolutions and technology diffusion. I think there's a lot in the model, a lot of detail in the model, but I've simplified it here to say there's really 3 stages to these technology revolutions. One is the installation period, 2 is the turning point, and 3 is the deployment period. And so you have kind of in this installation period setting up the capacity to install this new technology. There's a turning point, which often is kind of a scary part of the journey. And then there's the deployment period where the real value is created in society that was hoped for in the installation period. And so if we think of where we're at, there's a lot of investment in AI infrastructure right now. And we're seeing kind of massive capital expenditures by the largest tech companies, by companies all around the world. This investment is only continuing to increase. And it's raising these questions of like, how far is this going to go? Is this a good use of investment on behalf of these companies? And that's kind of one of the central questions a lot of people are asking. The messaging is clear and unambiguous. The risk of underinvesting is dramatically greater than the risk of overinvesting. So Sundar is kind of saying that on the Alphabet side. Similar messaging from Mark Zuckerberg. The risk of and this is an absolutely hilarious quote, misspending a couple $100 billion would be unfortunate, but the risk is higher on the other side. So I don't know if any of us that have built companies will get a chance to say that in our lives, but his point was the risk is higher in not investing. I think one of the things that's helpful is to kind of put this on some scale. And so I found this diagram helpful because it looks at AI infrastructure spending across many historical kind of infrastructure or investment projects in the U.S. And so what we see here is world wars, New Deal, railroads, and AI infrastructure, and the telecom bubble. So it's a little hard when you put it in this frame, you start to think, well, maybe it's not that much after all. But it is helpful to kind of see this just to put it in context. And I think one of the biggest questions people have is the recent memory goes back to the telecom bubble and in kind of the dot-com era. And I think a lot of people are saying, okay, is this like that? And so I thought I'd just give a couple data points. So one, this is a data point from 23 years ago. This was an article that was highly cited in the Wall Street Journal that looked at the telecom build out. And what you can see is this article makes a couple points. One, the expectation was that annual growth would exceed 1,000% a year in internet usage. The reality was 100% a year. And then this quote I've highlighted, nationwide, only 2.7% of the installed fiber is actually being used, okay? So this idea of dark fiber, people would say, oh, there's all this dark fiber. So in a sense, there's this massive infrastructure investment on building a technology infrastructure, but only 2.7% of it was used, a couple years in. So in a sense, overinvestment. And ultimately, it doesn't take that many years for that infrastructure to get used at 100% CAGR. But is that similar to now? Is that similar to what's happening in the AI revolution? And we got some clear feedback. There's definitely players like data center players that are kind of potentially talking their book. I ran a thing of it was saying, oh yeah, we're at full utilization. But we had yesterday in NVIDIA's earnings call, this was one of the most standout lines. The A100s we shipped 6 years ago are still running at full utilization today, now powered by a much stronger software stack. So what we're seeing is no dark AI clusters. There's no dark fiber equivalent. There's no dark AI clusters. All the AI token compute is being utilized at max capacity. And so that's a key differentiator and is really important to grasp, because it was one thing to kind of look at the past in the telecom bubble and say, oh, there was overinvestment, things weren't used for a decade. All these kind of inference GPU clusters seem to be, we're being told, like in full utilization, and that seems true. So that's a key insight. And I think when we have that as an observation, then there are questions on what's the return on those infrastructure investments, but at least we know that there is some kind of return in the sense that they're being utilized now. So if we dig in, I think as we dig into this, we can look at the AI build out. And this is essentially kind of how AI infrastructure looks like. And I wanted to kind of run through a few different areas in this graph. Obviously, we have data center infrastructure, the data center kit, we have semiconductors, we have models and software infrastructure, inference and cloud. So I'm going to cover a few different areas, and it's not obvious where in these areas is good to invest. But let's dig in. So first of all, we could talk about energy demand. So a lot of people are saying, okay, so if there's AI infrastructure build out, what's that dependent on? What's the gate? Power. So we can kind of work with that and dig in. So let's look at GE Vernova. So if we want power, maybe we want to look at the natural gas turbine market. So GE Vernova is one of the big players. They build gas turbines. And if we kind of look at the stock here, it's close to tripled over the last year. Over the last year and a half, and the PE ratio is now sitting at 94x. Okay, so that's maybe Maybe everyone's figured that out already. Okay, so maybe that side's a little harder. Let's think cooling. Okay, you're gonna have a data center. We're gonna have cooling, and there's a lot of heat from expending all the electricity. So let's look at something like Vertiv. So Vertiv is a cooling provider. There's a lot of like kind of liquid cooling happening now with some of the latest NVIDIA kind of platforms. But as we look here, we also see a massive increase in share price over the last kind of 2 years. So it's gone up 3 or 4x. So the market's already kind of priced in the reality of this, and now kind of PE ratio is now sitting at 63x. So that's a little tricky. Seems like maybe people have figured some of that out already over the last couple of years. We're a little late. Here's another, let's go to data centers. So here's a data center called Iron. They have smaller facilities in Canada and then a large facility they're building out in Texas. They suddenly became popular or well known in September. They did two things right over the last year. I invested in this in maybe February this year in Iron at about $10 a share. And they did two things right. One, they rebranded from a Bitcoin miner to be an AI data center provider. Earlier this year, they had a total of $2 million in data center AI data center revenue, so nothing. And they did two things right. They rebranded, and the second thing they did was they sponsored the All In Summit in LA, and I think booked out a whole floor. I wasn't there, but booked out a whole floor area and got a lot of visibility. And you'll see their stock price went from kind of below 10 to over 40. They also put out a press release about a month ago saying they're going to have like a huge deal coming, and they'll let people know later. So as this shot up, to me, it was completely overbought. And so I sold out at about kind of $40, $45. There was hope of a big contract, no data on the contract at all, and who's that contract is with. There's just a lot of capital flows because of their visibility. Now, they have subsequently, I think in the last week, announced a deal with Microsoft, which is a good long-term deal. And the markets now kind of price that in at that, in the high 40s. So companies like this are possible investments, but it's tough, right? If you get in at 10, that's one thing. If you're getting in now, the market's kind of fully priced in what's going on. And so the data center developers are not super clear. Okay, well, let's look at this. Let's look at the hardware, at the semiconductor side. And I'll just highlight one piece. This is an example of kind of like a GPU setup. You'll see on this, a lot of the content here is this high bandwidth memory. That's kind of what's in gold. So you obviously could invest specifically on those chips, but you could also invest in, say, Micron, for example, or Samsung, although it's very hard to invest in the high bandwidth memory side of Samsung because you have everything of Samsung in that ticker. So you could invest in Micron as a possibility, and that's something to look at. So of course, Micron has been run up, and these memory businesses are historically really not necessarily great returners. They have a lot of boom and bust cycles. And so today for Micron, the kind of PE ratio is now kind of 32x, up 2 times at least over what was there before. So the market's already kind of priced that in. Okay, let's keep going. Maybe we can invest in the software models side of things. So if we think of OpenAI, we're all kind of familiar with that, or Anthropic. So let's dig in there. So one of the challenges on the model layer is that the model layer pricing will be competed to death on price. And so this is just an example of OpenAI's pricing on their own tools. So this isn't showing all the competitor pricing, but this is just showing if you were to kind of access some of the GPT-440 models up to kind of earlier this year, you can see the significant drop on the pricing for these. So if there was any revenue that you had on this, the pricing is dropping at insane log level amounts. And what's more damning is quotes like this. We use OpenAI's latest models, but we typically don't use them that much in production because they're faster and cheaper models. So he goes on to explain that they'll use it to kind of test out some ideas, but when they go into production, they're not using OpenAI. And he goes in to say that they're actually using some of the Chinese open source models. And another quote that's maybe more clear from kind of on the venture capital side is saying, I'd say 80% chance that AI startups are using a Chinese open source model. So the story here is not on China versus the US in my view, although I think it's very wise for China to kind of do the open source strategy. The main thing is it's closed versus open source. And so what you're seeing is a lot of companies that are implementing this inference are using open source tooling to get the job done. And when they do that, that completely cuts off model revenue from the larger model companies like OpenAI or Anthropic. Now, it is true those companies do have the best models, but sometimes the last generation model, which open source has caught up to, is good enough to do the work. So I think the challenge here is when you look at some of these model companies, is that I don't believe there's going to be a return on that investment. And when you think of kind of OpenAI, there's this internal panic inside the business of how are we going to fund our massive expenditures on inference and compute next year? And you need to raise the next round at massive increases in valuation. There's not going to be a return on investment on this kind of inference model building spend. Now, OpenAI's consumer business or the kind of B2B business that's focused on like business applications, that's a very different story. And I think there's a story there. So you could price that differently than the underlying inference. So also on the model side, it's not super easy or clear that there's going to be a good return at all for those earlier investors, or definitely it's not clear there's going to be a strong return from this point. So I think if we go back to this model, what I find constructive is just to say that in this model, true value creation is in the deployment period. You're really creating value for society, let's say, in the deployment period. And so I think one of the questions is like, what does the deployment period look like? And how do we get there? And how do we invest in that? Because we can invest in the installation period, but the real value will be ultimately created in the deployment period. And so before we can do that, we have to go in this model through a turning point. And the turning point is, I think, best represented by this Gartner hype cycle, peak of inflated expectations, a trough of disillusionment, slope of enlightenment, plateau of productivity. And I want to just spend a couple examples. I'll give you 4 examples of what the trough of disillusionment will look like or is looking like now. And so I'll start here. One is in some cases, there's lower AI efficiency than expected. And here's just 2 data points. Constellation Software in a kind of investor call they had, I think about 6 weeks ago, talked about their implementation of AI tools that are on the market. Now, in some sense, Constellation Software is, for those that don't know, is this kind of holding company with 1,000 small legacy, let's say, software companies in it. These companies themselves, perhaps could innovate around AI, but may not. But they definitely would try to use the latest tools to help with coding, AI coding, and AI customer service. And so they made this interesting comment to say, we've implemented some of the latest tooling, and we're getting maybe 10, max 15% improvement in help desk resolution. We're not getting the 50 or 60% improvement we were promised by the vendors. The other example would be Airbnb. I had that quote earlier from the Airbnb CEO. In the same dialogue, they said, yeah, we combined 14 different models, and that was allowed us to offload like 10 to 15% of this particular use case of customer service. And it's just when you start to hear these examples, they don't sound like the 60% offloading that you would necessarily want to hear. It's a lot of work to get kind of single digit or very low double digit results. So that's one side of it, to just say, okay, the trough of disillusionment may sit here where the AI efficiency isn't what's expected. Another example is kind of dropping interest in coding agents. So this is kind of web traffic, but you can see there was a lot of hype around coding agents, and the hype is dropping off. And I think one of the biggest challenges that people are coming to realize is that these coding agents, at least in their form today, do not do what we thought they did. We thought they would kind of create this application and great, we're all set, but they actually are creating, a lot of people are saying, AI slop, or creating a bunch of code that has to be maintained by someone, and it's not well written. So I think the framing for coding agents is not that they're this panacea of giving us an infinite number of software developers and engineers that join the workforce at this stage. It's actually something different. It's creating a new category of software, which would be ephemeral software. Software you boot up for a week or two or a month or two to solve some problem, and then you retire it. That category of software never existed before, and there's a place for that. But if you're talking about long-term building and evolution and maintenance, we're very far from getting massive improvements and the replacement of software engineers. So there's a hype around it, and then there's the reality of what's happening here. I'll give you another example of what this trough of disillusionment could look like. This MIT study, it's kind of been talked about quite a bit in the last month or two. And the headline of it is 95% of GenAI pilots fail. And so you start to see that, okay, there's a lot of investment, but people are really struggling with how do you get these pilots to work? And so the question for us is probably not what are the 95% doing, but what are the 5% doing that's being successful? And I think this is where we start to get some hints at the slope of enlightenment. What is this going to look like? And when we drill into this, that study actually has some very interesting findings. And I'll just summarize the four from you. These are the four things that have to be true to be in the 5%. So one, there has to be a narrow focus of the application on a specific workflow with fast time to value. Two, there has to be adaptability. Three, which is the system can learn. Three, it has to be context aware. So the system has to be integrated with existing data systems. And fourth, partnering. Partners, the companies that partnered with vertical AI software vendors were twice as successful as the ones that didn't. Okay, when I see this, you know what this says to me? This says vertical market software is not dead. This is exactly what vertical market software companies have been built to do since the beginning, and that's where we're getting the successful implementations of AI. And I think this gives us the key kind of foundational clue of what kind of the enlightenment is and what the ultimately the plateau of productivity could look like. And we see this in some of the data when applications fit that profile. We're seeing significant revenue increases and significant cost decreases. So you are seeing the benefits, but it has to be in this kind of 5% of scenarios where they're configured the right way. So ultimately, what we call this is the AI workforce. This is an emergence of a new workforce, a new AI workforce. And I want to explore a little bit just to kind of lay the stage for it. So if we think of kind of B2B SaaS or B2B software market, that historically has been, let's say, a $230 billion market in kind of North American markets. And then if we think of labor, we can think of labor as about a $5.5 trillion market. So you have these kind of two pieces. And now we're getting something that's entirely new. We're getting a new AI workforce, and this AI workforce is giving us the ability to multiply the capacity of the labor market. And so we see the emergence of a new class of company, which is an AI workforce company. And this gets us very excited. And so I thought I'd spend a moment just to kind of give a couple examples. And so this first one, I'll give an example, two examples. This is a company we're working on in the dementia care space. And essentially, in the past, a doctor would have to spend half an hour with a patient to do a dementia assessment. That's often sitting in the clinic. Only 17% of doctors, when they are supposed to do this, do it because they don't have enough time. And so we've built an AI worker that's able to do these assessments kind of separately from the doctor and give the results to the doctor all by voice. So I'm just going to play a clip. The first part is going to have a phone ring. It's very loud. It'll stop, and then you can kind of listen to the conversation, and we'll describe it.
Hi, Melba. This is Carey from Caring.ai. I'm here to walk you through a quick checkup for your memory and thinking today. It's a simple and friendly process to help us understand how your mind is working. How's your day going so far?
My day is going well. Thank you, sir.
That's great to hear, Melba. All right, let's get started. This will only take a few minutes, and I'll guide you every step of the way. Let's begin the check-in now. First question, what year is it now?
It's 2025. Can you believe it?
It sure is. Time flies, doesn't it? Next question.
Well, I'll just stop there. This gives you a sense where before a doctor had to spend half an hour, or a nurse practitioner, 20 minutes to 30 minutes to do that, we now have these clinics hire an AI worker to do that assessment. And that is a new type of AI worker employee that's joined the workforce. I'll give you a second example. This is an example of a company called Addy, which is focused on college admissions. And we have an AI worker that essentially acts as a college admissions counselor. Now, you might wonder what that involves, but to kind of give you some of the stats, this AI college counselor is talking by voice with students, and already in kind of the work that we've done, we've been able to kind of do 30-minute calls with all of these students. And so already Addy, as an AI worker, has done more than 6 months of what a counselor normally would do with students. And we expect that to kind of 100x from here, as Addy can be a global college counselor for high school students. And so it's very interesting to see these kind of use cases where there's essentially the college in these high schools, for example, someone in charge of college counseling or counseling in general can now choose to hire Addy to build specific kind of AI, like as an employee, to work with their students alongside them. And they're delighted to do that because they don't have the capacity to do what they want to do. So you see kind of when we kind of look at this, when we look at this model, the demand for knowledge work labor is probably 10 or 100x what we can afford. But if you can drop the price for labor, the demand will increase. Okay, so let's just kind of wrap that up. So that essentially is a clue, some clues for you in terms of what the plateau of productivity looks like. So how do you invest in knowledge workers? Or sorry, how do you invest in AI workers? And I want to just first highlight that these kinds of applications are all being built are mostly being built in very early stage companies that aren't in the public markets. And so if you want to invest in these AI workers, there's really kind of 4 ways to play this. One is to kind of play more direct investing or angel investing, where you're doing individual deals. There's a place for that, especially if you have kind of deep domain expertise and see the potential of a company. One of the challenges there is you need a sufficient portfolio, though, because some will not make it and some will substantially make it. So you have to kind of be thoughtful about how many investments that you make. There's also the secondary market. There's a lot of clamor for some of the top companies, whether it's kind of getting into a single purpose vehicle, SPV, for OpenAI or Anthropic or Anduril. Or SpaceX. There's a lot of fervor around kind of getting into these companies. So those secondary market transactions are often like very late stage. And usually they're not in a fund structure. It's more kind of an individual deal. So you're not getting diversification. And then in the more diversified approach, you can invest in a venture studio, and that's what FutureSight is, and in venture capital as well. And on the venture, so I'll just spend a little bit just to kind of describe the venture studio a bit more. Now, Krista highlighted before, so FutureSight co-founds and funds vertical AI companies with values-driven leaders. And kind of the way this works, if you think of kind of ownership in an early stage company, there's kind of VCs that are going to compete to invest in a slice of a company as they've kind of formed and gone a little further. And so kind of the market for that is very intense. There's about 3,000 kind of early stage investors. There's not enough high quality deals, and that bids a lot of the prices up to kind of unhealthy valuations. And our approach is, when I've kind of looked at that, I basically said, you know what, I'm not going to play in that sphere. The kind of market pricing is not healthy or constructive to kind of make it a long-term work in the long term. And so the approach we've taken at FutureSight is very different. We've said, rather than just being an investor, because there's often this question of, do you build or buy? And our approach has been, we want to build. We can buy in the market with 3,000 competitors pricing deals kind of to insane valuations, or we can get our hands dirty and build. And so what we do is we join our co-founders as one of the founders of these businesses. And when we do that, that gives us the ability to obviously contribute a lot of value as a co-founder. And so when we meet founders, they often are doing, and there's kind of a class of founders that say, I don't want to build alone. I want to have a co-founder. There are some that are just like, nope, I want to go on my own. I want to be by myself, autonomous and independent. I don't want to have any partners. But for the ones that want to kind of build with partners, they go through this partner selection process where they say, hey, I could co-found with someone I know, or I could co-found with a team co-founder. And we as FutureSight are a team co-founder with a cross-functional expertise across many different areas. And we've kind of done a lot of work systematizing a process around how do you build venture scale companies. And what we find is often one of the most kind of sought after things, at least from kind of the VC investment perspective, is, has a founder done it before? Are they a repeat founder? And the main heuristic that gets to is, are we not going to make the stupid mistakes? Are we going to kind of get there? Has this founder done it before? But if you think about it, if founders that have done it before, and I have as well, how many times have they started a company? Okay, they're a repeat founder. They've done it 2 times. They've done it 3 times. Very different than an Olympic athlete that has done the same course 1,000 times, right? So you've done it a few times, but very few repeat founders have done it 4 times or 5 times or 10 times or 100 times. And so in FutureSight, we essentially have a team where we're compounding a lot of expertise and learning every step of the way. And many of these steps in our venture build process, which goes from ideation to validation to formation to spin out, we've done hundreds of times now. And so those reps and compounded learning in our team give us an unfair advantage, not only for kind of us and our investors, but also for the founders that we work with. So ultimately, we get much better risk-adjusted returns operating as a co-founder and building the companies and joining with kind of founder level equity than coming in much later as an investor in kind of broad market pricing. And so that gives us a unique place to play. Now, it's very hard to do this well. And so we've been at it, compounding learnings weekly for a number of years now, and we're excited to keep doing that for years to come. So just to kind of wrap up on us, we have a $15 million fund. We're doing a final close in December 2025, and there is room for participation. And so if that's of interest to you, we'd love to chat more. And Krista, I'll pass it over to you.
Great. Thank you so much for that, John. That was very insightful. So we're going to open it up for Q&A now. But really, really important for us is some feedback. And so Cindy is going to share the feedback link in the chat. And there's also this QR code here. So if you could get your phones out and get through to the the feedback form, that would be wonderful. We do have some questions coming in. So I'm going to read through some here, but I have one to start, John. We get asked this a lot. Can I just invest in the S&P 500 and get a good return?
Yeah. So this is, I think, a really good question, and there's a couple answers to it. So one, yes, I think S&P 500 is definitely like a great place to invest. And my mental model is a barbell model. So one model where you're investing kind of in a diversified pool of public equities, but then also having another side of the barbell that's kind of higher risk, higher return potential. And so the kind of highest return potential we see right now is in this kind of space around the emergence of AI workers. And that's where I see that investment really playing out. And so some of the value will percolate, through all these vertical market software companies doing work with these large public companies. Some of the value obviously will accrue to those large public companies, and you'll continue to get earnings growth and things like that, especially as they don't necessarily have to increase labor expenditure as they're getting more kind of AI workers joining their teams. But I think for the real exponential growth, you kind of want to be investing in this area.
I'm on mute. Thank you for that, John. Here's another question. How do you plan to compete? Just scrolled up against deep-pocketed PE-backed and public insurtech companies that can afford steep discounting?
Okay, PE-backed and public insurtech companies. I'm not sure I fully understand that question. I think what's interesting in this space, especially on the early stage side of things, is so one, we can talk about like our strategy and private equity, or just generally like early stage technology and private equity. So typically the private equity, the way I think of private equity is it's a good, it's going to give you the equivalent of like public market exposure, largely. Obviously in the private markets with less liquidity. Some analysts would say that it's actually a little worse than that. Private equity in general, like if you're buying a bunch of funds, and it's very hard to generalize because there's so many very specific funds, but private equity in general, if you say kind of middle market private equity, essentially is like it's like equal weight S&P 500. So you get kind of that exposure plus some additional premium because of the illiquidity. And so when you look at the evergreen PE funds, you start to see kind of performance in the low teens, and that gives you a sense of kind of like what the underlying performance of that looks like across the board. But I didn't fully get the whole insurtech side, so maybe we can come back to it. But just to kind of wrap that question, I think there's a place for that in an investment strategy. But if you're saying where is the real asymmetric return going to be generated in markets, because when you look historically, 90% or more of the return, even of public markets, is asymmetric return from outliers. That's where we want to be, and that's where kind of we see that emergence.
Great, thanks. Yeah, and we can follow up with that question over email to make sure we answered it appropriately. So here's another question, John. What's your playbook for building a defensible, scalable AI SaaS venture in a niche regulated landscape? And I think this relates back to the insurtech as well, and maybe the topic of industries that we don't build in.
Yeah, so I think one of the questions we sit on a lot is what is the role of kind of these AI workers in regulated industries? And it's not, it's not very simple. There's some industries, if you take, for example, we looked at something in like clinical trial management. There's a role in clinical trials that are run. That's kind of a clinical research associate. So you can have these clinical researchers, they visit the different clinical research sites and they do work. So we dug into that and we realized, okay, well, from a regulatory perspective, there has to be this person sitting at the site looking through all the data. And the main job is actually the travel. They're physically traveling and it's their certification. So we had the capacity to build AI to do a lot of the work they were doing, but we realized we didn't 10x the capacity of that clinical research associate. We only were really able to kind of 30% increase their capacity because of the regulatory requirements. So that's an example where it's like a regulated industry, and because of the regulations, you're not able to really get this kind of asymmetric 10x, 100x productivity improvement as a result of that. So we've looked at hundreds of these in different scenarios. And so the regulated industries are tough, but it depends on the type of regulation. I think another one that's challenging is the legal profession. We looked, and I have a friend that's doing really well in this, but it's very hard when the regulatory moat is that no law firm that provides legal services can be owned by a non-lawyer. So you can't even have an investor in a law firm in that sense. And so when that moat exists in many different, for example, US states, it makes it hard to kind of take aggressive bets. But there are ways to do it. And then you have to, and if you figure that out, then you might have a unique moat.
Great, thank you. Okay, here's another one. If to add real value, we need to select a vertical and then find a specific use case, which is integrated with existing flows, does this limit the potential upside and market size for the specific venture?
It's a great question, Yuval. So I think the answer is yes and no. There's a lot of these markets that are large enough in and of themselves. So if we take healthcare or something like that, it's a huge market. Obviously, you're starting at a specific use case in that vertical, and so that's I think my view is there's two stories being told. There's the story which is kind of a mid to long term vision on what's going on with this technology in this customer segment you're serving. So here's what's going to happen over the next years, and then here's the use case that we're starting with that's hitting it out of the park today. And I think those both can be true. It's a narrow, focused use case. The TAM on that is relatively small when we're talking in billions of dollars, but the bigger vision can be much larger. So, but there is a tension there. And I think the people that are kind of building or even, if you're talking to investors about it, you kind of have to straddle both worlds to kind of hit the asymmetric upside opportunity and also hit like you're creating real value. But I definitely would bet on creating real value versus just a hype story any day of the week.
Great. There are a couple of questions skirting around one common theme, and that is what industries or verticals is FutureSight focused on versus what do we not focus on?
Yeah. So we've been, we're fairly broad. We definitely are focused on this AI worker tier. So that starts to exclude different things for us. We exclude biotech. We exclude kind of deep tech, where the path to creating these AI workers is 5 to 10 years out. We want we want quick time to value. We feel the technology is robust enough that there's a lot of kind of gold on the streets in terms of use cases. We don't need to wait too long, so we're definitely focused on the getting to market quickly and creating real value. And we are focused on the business use cases in businesses, things business would buy to implement these AI workers.
Great. Question about that we get asked frequently: how long is a venture typically in our studio for?
Yeah. So typically the ventures are in the studio, 6 months to 2 years. But our target is in the 6 to 12 month range.
Okay, here's a question from Sanjay. What is the role of hype of 1 to 2 year AGI timeframe that is driving the bubble discussion?
Yeah.
And then 2, circular valuation bubble in top companies, OpenAI, NVIDIA, Oracle. So if you could comment on that.
Yeah, so the first one on the AGI hype, that is, it's a good you raise it, Sanjay. Like when Mark Zuckerberg says the risk is higher on the other side, what he's saying is we think AGI is a couple years away, and the value of unlocking, like infinite low cost labor is insanely valuable, and we got to own it. Or being able to kind of take us to the next level of humanity by being able to do so many things that we haven't been able to do yet, new discoveries and things like that. So yeah, I think that is a big part of the bubble narrative. My sense is even with the latest models, I feel like we've already hit. Uh, if you look at, I don't have a slide here, but if you look at all the results, even there's kind of a new model that came out this week from Google. We're just breaking every single benchmark every 6 to 12 months. And so every benchmark that's out there, we've almost pretty much broken it. Then we have to create new benchmarks. So it's like, how many times do you have to go through breaking through in terms of performance levels, all these benchmarks where you say like, we're there? We have to kind of create all these new benchmarks in a bunch of areas because the technology is exceeding it. So our view is that there's already, like if you think of the surface area of what could be done today that has not yet been done, I feel like the intelligence level we already have in business applications can, when specialized in those 4 ways through vertical market software companies, has the ability to do a ton of this work already. So that hype is there, and I think that drives, just like, I don't care about the price, I'm just going to put my money in because it's kind of an infinite exponential curve. I don't think that's wise. Like you need to know you have to have a take on what you think the pricing is ultimately going to be. And I don't think we should kind of willy-nilly throw that money around. But I feel like to me, AGI is not here, but the technology is already so useful when the work is done to specialize it into AI workers that I think we've already achieved what many people dreamed of 5 years ago.
Sorry, I'm on mute. Okay, there's still time for questions, so please keep them coming in. I have one for you, John. As a builder and as a technologist, what are the exciting parts about AI? Like what gets you excited about this era that we're in?
Yeah. So what I'm excited about is essentially how we have these models, like the model companies and the model developers, like if you think people in OpenAI or Anthropic, they have no clue how this technology is going to be used. They're essentially building this general purpose, like intelligence engine that processes tokens. But so the next step of like, how are we going to implement this in society to create value? To me, that's really exciting. And it's also exciting just to be able to do a type of work you never would have been able to do before. Just an example, we have a tool that analyzes kind of investment opportunities. And I can run this thing overnight, and it did over a year of analysis work overnight. Like we've had to have like 5 analysts for a year doing work overnight. We were able to do that. So there's all these use cases that just no one's dreamed up of yet. No one's figured it out yet. And I've now looked at over 5,000 early stage companies in the last year, just like for pretty much everything that's active in this AI worker space. And my sense is that people aren't imaginative enough. I mean, there's so many very simple tools. I mean, tools, solving basic things, but the potential is 10x in terms of the use cases that we can build out. So it feels kind of blue ocean to me in that sense, and that gets me really excited.
I totally agree. Okay, here's a question about the fund. What is the target net return for the fund?
Yeah. Yeah, so our target kind of return is in that kind of 20% plus IRR. This is obviously, this type of investment is a long-term investment. We're investing early stage, and it takes time for these companies to mature. So it's definitely for someone that has kind of the patience to kind of play these bets out, but that's kind of the range that we're in.
Great. There aren't any other questions that have come in, but we have a couple more minutes. So if you have a question you would like John to answer, now's your chance. And so as mentioned at the beginning of the webinar, you will be receiving a recording of this. Give us a couple of days. And we have another question. What is the average check for your company for pre-seed round?
Yeah, so yeah, maybe we can talk more one-on-one on that, but it varies.
Yeah, we will follow up with you, Arthur. And all right, we're a couple of minutes to the top of the hour, and we thank you immensely for your time. Thank you, John, for your wisdom and the opportunity for us to listen to you. And there's lots of clapping going on. We will follow up. And if you have questions that you want to ask us, just reach out through our website and we will get them answered. So
Awesome.
we'll call that a wrap. Thank you,
Okay.
John,
Thank you,
and thank you,
everybody.
everyone.